Hey everyone, and welcome. Today we are going deep under the hood of a company that is, maybe quietly, but oh so powerfully, shaping the entire future of technology. And that is Arm Holdings. We're going to break down their latest results for the second quarter, and let me tell you, it reveals a company that is just firing on all cylinders. So, let's dive right in.
All right, here's the game plan. We're going to walk through this just like a pro analyst would. We'll start with the big picture stuff, their strategy. Then we'll drill down into those juicy quarterly numbers, dissect the income statement, check on their financial health by looking at the balance sheet and cash flow, see what management is saying about the future, and finally we'll pull it all together into a clear, concise conclusion.
Now, before we even think about touching a spreadsheet or a financial table, it is absolutely crucial to understand what Arm actually does, and, more importantly, what it's trying to become. This is the what and the why that gives all the numbers we're about to see their real meaning. And for this whole analysis, we are going straight to the source. We're using the company's own letter to its shareholders as our guide. We're going to unpack their story, their data, and their outlook, literally piece by piece, to build a really complete picture for you.
So, what's the core business model here? Honestly, it's fascinating and incredibly powerful. See, Arm isn't like an Intel or an NVIDIA. They don't build or sell any physical chips. Instead, they design the blueprints, the fundamental architecture that pretty much everyone else uses to build their chips. And they make money in two key ways. First, they charge an upfront licensing fee just for access to the designs. And second, they collect a small royalty for every single chip that gets sold using their tech. I mean, think about it. It's the ultimate scalable business. Design it once and get paid billions and billions of times over. Right, so with that business model in mind, their strategy for today's world makes perfect sense. Arm has this unbelievably ambitious goal: to be the essential, unified foundation for the entire AI revolution. And they use this fantastic phrase from milliwatts to megawatts, which just perfectly captures what they're trying to do. It means they want to power everything from the tiniest low-power chips in a smart sensor all the way up to the massive, power-guzzling servers in a data center.
And this isn't just about one single market, not at all. Arm sees itself right in the middle of three huge connected AI domains. First up, you've got cloud AI. Think massive data centers run by giants like Amazon and Google. Then there's physical AI. This is intelligence in things that actually move around. Self-driving cars, advanced robots, you name it. And finally, Edge AI, which is all the on-device smarts in the gadgets we use every day, like our phones, our computers, and all those smart home devices.
And look, this strategy isn't just some nice-sounding idea on a PowerPoint slide. It is absolutely happening in the real world. The perfect example is this right here, the NVIDIA Grace Blackwell Superchip. These things are the hottest AI chips on the entire planet. The shareholder letter says demand is exceptionally strong, with over $500 billion in expected orders through 2026. And here's the kicker: the CPU, the brain of these superchips, is built on Arm's Neoverse platform. This just goes to show that the biggest name in AI, NVIDIA, is betting its flagship products on Arm.
Now, to make it even easier for customers to use their tech, Arm is selling more and more of what they call compute subsystems, or CSS. You see, as chips get ridiculously complex, instead of just giving a company a bunch of individual blueprints, Arm now offers this pre-packaged, pre-tested bundle of their best stuff. This is a game changer for their customers. It slashes their development time, it lowers the risk, and it gets them to market way faster. It's really a brilliant move to sell more value and become an even deeper partner.
And the demand for this stuff, it's blowing past Arm's own expectations. In this quarter alone, they signed 3 new CSS licenses, one for phones, one for tablets, and another for data centers. That brings the grand total up to 19 licenses with 11 different companies. And the shareholder letter says CSS is becoming a significant tailwind for royalty revenue growth. Remember that phrase because it is super important.
Okay, so we've got the strategy down. We know what they're trying to do. Now for the fun part, the numbers. How did Arm actually do in the second quarter?
Well, in the word, fantastic. The quarter was just exceptionally strong. Total revenue didn't just pass the billion-dollar mark, it smashed through it for the third quarter in a row, landing at $1.135 billion. That's a huge 34% jump compared to this time last year.
You know what makes that number even more impressive? It wasn't just good, it blew away their own expectations. Management had told Wall Street to expect somewhere between 1.01 and 1.11 billion. So to come in way above the high end of that range, well, that tells you the business has some serious momentum, even more than they thought.
And listen to what the CEO, Rene Haas, had to say. He directly connects this success to the core of their business. He points out that the record-breaking royalty revenue shows a new high in demand for the Arm compute platform. So this isn't some one-off fluke. It's a sign of deep, broad adoption across the entire industry.
And all that fantastic revenue on the top line flowed right down to the bottom line. The company reported non-GAAP earnings per share of 39 cents. And just like with revenue, this number also comfortably beat their guidance, which topped out at 37 cents.
All right, let's start peeling back the layers on that impressive $1.135 billion revenue number. I mean, to really get what's going on with this business, we need to know exactly where all that growth is coming from.
So, as we touched on earlier, Arm's revenue comes from two main streams. In Q2, the bigger slice of the pie, 55%, or $620 million, came from royalties. That's the money they get every time a chip is shipped. The other 45%, or $515 million, came from licensing. Those are the big, upfront fees for access to their designs.
Now this breakdown actually tells two different stories. The license revenue was on fire this quarter, up a massive 56% from last year, which they said was because of a few big deals closing. But that number can be a bit lumpy, up and down. The real story, the one that tells you about the long-term health of the business, is that royalty revenue. It grew a super healthy 21% to hit a new record. That's the steady, recurring part of the business that just shows more and more people are using their stuff.
Okay, a 21% jump in royalties? That's a big deal. That's the engine of the whole business firing on all cylinders. So, what's the secret sauce here? Let's dig into the specific reasons the company gave in its shareholder letter.
So the documents point to a really clear and powerful trend. It's not just that more chips are being sold, it's that customers are moving to more advanced and, for Arm, more profitable technology. First, their newest design, Arm v9, is being adopted faster and faster. Second, and this is so important, Arm v9 gets a higher royalty rate per chip because it's just better, especially for things like AI and security. So every time a customer switches to Arm v9, Arm makes more money. Third, they're gaining share in super valuable areas like data centers. And finally, that CSS stuff we talked about is creating another nice boost.
And you can literally see this story playing out right here. This chart is straight from their investor deck. Just look at the top part of each bar that's growing so fast. That's the latest Arm v9 architecture. It went from basically nothing a couple of years ago to a huge chunk of their royalties today. This one picture perfectly shows you how they're making more money per device, and it's accelerating their growth.
Now, as we move down the income statement to look at how profitable they are, you're going to immediately see two very different numbers. The official accounting number, what they call GAAP, is 14.4%. But the number Arm really wants you to look at, the non-GAAP number, is way higher at 41.1%. So what gives? Why the huge difference?
Well, the single biggest reason for that gap is something called share-based compensation, or SBC. It's basically a non-cash expense that accounts for the value of stock and options they give to their employees. And for a tech company like Arm, which is fighting for the best engineers in the world, this is a huge number. We're talking $265 million in this quarter alone. So by taking that out, the non-GAAP numbers try to show you the underlying cash-generating profitability of the actual business.
Look, a great income statement is one thing, but for the complete picture, you have to look at the balance sheet and cash flow. I mean, cash is king, right? So let's check out Arm's financial foundation and see how healthy it really is.
The first thing that just jumps right off the page is the massive amount of cash this business generates. During the quarter, their core operations brought in a whopping $567 million in cash. That is the lifeblood of the company, and it's what funds all their R&D and future growth.
Okay, let's follow the money here. This table shows us how we get to one of the most important metrics out there, free cash flow. You start with that big $567 million number from operations. Then you subtract the money they spent on things like property and equipment. And what you're left with is $411 million in free cash flow. That's the cash the company has left over after running the business and investing in itself. It's pure financial firepower. And now for the balance sheet. Man, these numbers just paint a picture of a financial fortress. The company is sitting on over $3.2 billion in cash. Total assets are almost $10 billion, while their total liabilities are just a tiny fraction of that at $2.3 billion. That gives them this massive cushion of shareholder equity. This is an incredibly strong and clean balance sheet. It gives them all the flexibility in the world to invest and innovate. Okay, so the past quarter was awesome, what analysts call a beat and raise. But what about tomorrow? What does management see coming down the road? Let's look at their official guidance for next quarter and, just as importantly, the risks they're telling investors to watch out for. The outlook for the next quarter is still looking really strong. Management is expecting revenue to actually grow from this quarter to about $1.225 billion. They also see their non-GAAP earnings per share ticking up a couple of cents to 41.
This basically tells us that they expect the strong momentum they're seeing right now to just keep on rolling.
Of course, no investment is a sure thing. So for a complete picture, we have to do a reality check. We have to consider the potential headwinds and challenges that could throw a wrench in the works, and the company itself tells us what these are.
So Arm lists a few key risks. The obvious one is their dependence on the overall health of the chip market. If people stop buying electronics, Arm's royalties go down. They also rely on a few very large customers for a big chunk of their revenue, which is always a risk. There's the constant battle to protect their designs from being copied, and like any huge global company, they're exposed to all the usual stuff: currency swings, geopolitics, and even potential conflicts with their biggest shareholder, SoftBank.
All right, let's land the plane. We've covered the strategy, the fantastic quarterly results, the rock-solid financials, and the road ahead. So, let's pull all these threads together. Based on everything we've seen in their own documents, what's the final verdict on Arm's trajectory?
Based on a deep dive into their shareholder letter and their investor deck, the only conclusion you can really draw is that the company's trajectory is improving. The business isn't just growing, the fundamentals are actually getting stronger, and the pace of that growth seems to be picking up.
The first and honestly most important reason is what's happening with their royalty revenue. The very engine of the business is getting souped up. It's not just about more chips anymore, it's about more valuable chips. That shift to the higher royalty Arm v9 design, plus their gains in rich markets like data centers, is creating this powerful updraft that's lifting the average amount of money they make on every single device. Reason number 2 is just how successful their AI everywhere strategy is. I mean, the proof is right there in the pudding. They are becoming the one platform you just can't do without in the AI era. You just have to look at their partners: Meta, Google, AWS, NVIDIA. Literally every major player in the world of AI is building their future on top of Arm technology.
And finally, the business model itself is just a thing of beauty. Because they only design the IP, they don't have the crazy costs of building chip factories. This leads to these mind-boggling non-GAAP gross margins of over 98%. Think about that for a second. For every dollar of revenue, 98 cents is available to cover operating costs and become profit. That's an efficiency most companies can only dream of, and it lets them pump out cash, which they can then pour right back into R&D to stay ahead of the game.
And that wraps up our deep dive into Arm's stellar quarter. The company is absolutely at the top of its game, sitting right at the center of the AI universe. But it does leave us with one big question for the future. Arm is the common language of computing today, for sure. But as AI gets more and more complex and specialized, can any single architecture, any single company, continue to be the one-size-fits-all foundation for an entire industry that is just getting started? That's the challenge and the massive opportunity that lies ahead for them.